Good afternoon, everyone, and thank you for joining us for the Provider Relief Fund Reporting Guidance webinar. This webinar will be recorded and will be available on the RPA website under Education and listed on the e-learning page. We are pleased to have representatives from McGuire Woods present today's webinar. I'll now turn it over to Ms. Kim Cannison, RPA's legal counsel, so she can introduce our panel of speakers today. Kim?
Thank you very much, Desiree. My name is Kim Cannison, and I'm a partner in the healthcare group at McGuire Woods. I focus my practice on the provision of advice to our provider clients, including nephrologists, nephrology practices, and dialysis providers. And as Desiree mentioned, I'm also counsel to the RPA. With me today are our two principal speakers. First is Colin McCarthy. He's counsel in our healthcare department, and he focuses practice on the provision of regulatory and reimbursement counseling and compliance counseling to our provider clients, and he is one of our experts on the Provider Relief Fund. And then also with us today, Neshko Radovich. Neshko is an associate in the healthcare department at McGuire Woods, and he assists our clients on a range of regulatory and transactional matters, including advising clients on Provider Relief Fund issues. We're going to start today by providing you with some brief background regarding the Provider Relief Fund, and then we're going to quickly jump into issues regarding the reporting requirements, the portal, the new portal that recently opened on July 1st. And then we're going to talk at the end about compliance and auditing and try to provide you with some tips to prepare you for audits. Please feel free to submit your questions during the presentation. If we have time, we will address your questions, but we have a lot of material to go over. So if we can't address your question today, if we don't have time for it, then what you should do is just feel free to contact any one of us, and we will address your questions after the presentation. In addition, the presentation, a hard copy of the presentation is going to be made available. Desiree will provide you with more details about how to get a hard copy following the talk today. At this point, I'm going to turn it over to Neshko Radovich, who's going to address our first topic. Thanks, Neshko.
Thank you, Kim. And as Kim mentioned, just like our little illustration shows, if you have any additional questions, just send us, because we do have your back always. So if we can go to the next slide. To provide some background on the Provider Relief Fund, let's address the legislation that allocated the money. So the CARES Act was the first large piece of legislation which was signed in law in March of 2020. And it came after the scope of the pandemic and the health emergency, after the fact that the scope of the pandemic and the health emergency was actually known. The CARES Act enabled the government to make the first payment to providers in response to the coronavirus pandemic. And as many of you know, this pandemic was made on April 10th, 2020, when a large number of providers, including nephrologists and nephrology practices, received extra money in their bank accounts, and many of whom didn't know where the money came from. So the CARES Act appropriated $100 billion for Public Health and Social Services Emergency Fund, and those funds are available today, and they will remain until expended. The CARES Act was also supplemented by additional funding through Paycheck Protection Program and Healthcare Enhancement Act, or simply PPP program, which was signed in law on April 4th of 2020. Now, the PPP program allocated additional $758 million, and both of these acts together, the allocation of the funds was generally known as CARES Act funding. Now, that name slowly went away as Congress passed additional legislation, including the Coronavirus Response and Relief Supplemental Appropriations Act, which allocated additional $3 billion in the PRF fund. Now, congressional action to date has included the Omnibus Appropriations Act, and then finally the American Rescue Plan, which is the first major piece of President Biden's administration and its response to COVID, added an additional $4.8 billion in funding, and it largely addressed COVID-19 testing for the uninsured. Now, as the next slide says, Provider Relief Fund was established to reimburse healthcare providers for healthcare-related expenses or lost revenue due to COVID-19. Now, up to date, the government has allocated approximately $175 billion total worth of payments to be distributed through the PRF. Now, these payments are not considered a loan. However, nephrologists and nephrology practices may face recoupment if they cannot substantiate that their lost revenues and increase in expenses is attributable to coronavirus. Now, finally, as a condition of receiving these funds from the Provider Relief Fund, providers were required to attest to receiving funding and to accept the terms and conditions of the Provider Relief Fund. Now, these terms and conditions require compliance with reporting requirements, and these requirements are what we will be discussing in more detail today. Now, the payments to providers also had a number of different names. HHS has first called them rounds, phases, tranches. There are general distributions, there are target distributions. So let's just untangle this a little bit. The general distribution payments made in the form of were made in three phases and started with the April 10th, 2020 payments. In the first tranche of phase one, which was the payment on April 10th, the HHS distributed $30 billion to eligible providers who billed Medicare fee-for-service in order to provide financial relief. Now, the second tranche provided additional $20 billion of payments. So these funds were allocated proportional to provider share of annual patient revenue and based on Medicare revenue for the prior year. Most of nephrologists and nephrology practices would have received their payment within these two payments. As part of phase two of general distribution, HHS distributed around $6 billion to providers that included participants now in state Medicaid and CHIP plans, also Medicaid managed care plans, and certain Medicare providers that did not receive phase one general distribution payments. Finally, in phase three, HHS made $24 billion of new funding available, and these were to previously eligible providers and to providers that were not eligible before, such as newly licensed providers or providers that had a change in ownership. So total of the general distributions was around $70 billion. So finally, HHS also made targeted distributions, which included funding allocated to providers in areas particularly impacted by COVID-19, such as rural providers, skilled nursing facilities, nursing homes, as well as safety net hospitals and providers requesting reimbursement for the treatment of uninsured Americans. Now, as you can see on the map, and this map is available on the HHS website, we are up to $140 billion. And just, in preparation for this webinar, I had to change the map about 4 or 5 times because the numbers just keep growing and growing. So providers were required to submit an attestation to the terms and conditions for the first tranche of general distribution, and then they were required to agree to it as the second tranche as well. So providers were required to confirm the amount of the payment, supply an estimate of lost revenues, submit tax returns, and finally, providers were required to agree to a possible HHS audit in the future. It is also important to note that providers that retained the funds past 90 days, but did not attest to the terms and conditions or did not contact HHS regarding remittance of those funds, are deemed to have accepted the terms and conditions. Recipients were also required to certify that they were actively providing diagnosis, testing, or care for individuals affected by COVID-19, that they were not terminated from Medicare, not excluded from any federal healthcare programs, and they did not have their Medicare billing privileges revoked. HHS also required providers to certify that after January 31st, 2020, because the payments were based on 2019 numbers, They provided diagnosis, testing, or care for individuals with possible or actual cases of COVID-19. So each distribution of PRF payments required recipients to take prudent steps in complying with the terms and conditions attached to such funds. Specifically, the CARES Act created 3 oversight bodies, which include the Office of Special Inspector General for Pandemic Recovery at the Department of Treasury, the Pandemic Response Accountability Committee, as well as Congressional Oversight Committee, to oversee the distributions and reporting of these funds. Also, beyond the actions and activities of these oversight organizations, the United States Department of Justice, DOJ, has also taken the position that failing to adhere to the rules of the program or comply with terms and conditions can result in government enforcement actions. And these can include, returning the funds, debarment and exclusion, as well as, all the way up to civil and criminal sanctions. So on the next slide, the terms and conditions contain compliance reporting requirement and enumerate specific permitted uses of the PRF funds. Specifically, recipients are required to sign an attestation certifying that the funds will only be used to prevent, prepare for, and respond to the coronavirus, and that the funds shall reimburse the recipient only for healthcare expenses or lost revenues that are attributable to the coronavirus. Further, the attestation requires the recipient to certify that it will not use the funds to reimburse expenses or losses that have been reimbursed from other sources or that other sources were obligated to reimburse. Now, accordingly, PRF payments must not be used to reimburse expenses or losses that have been reimbursed from other sources, and should be treated as sort of a last resort payment, but I'll address that in a little bit more detail later. So if all of other funding received has been expended, that's when providers should use the PRF funds. At least that is the position of HHS. So there are a couple of categories of specifically prohibited expenses, and these are, recipients may not balance bills COVID-19 patients. Now, there is some interpretation that the balance billing does not apply to commercial patients only. However, if the providers are providing services for both commercial and Medicare patients, this would be prohibited for both. And then to ensure compliance with PRF terms and conditions, recipients should be judicious in providing extra compensation because these funds are subject to the long-standing cap of Executive Level 2 rule of the federal pay scale for any HHS cost reimbursement grants and contracts. So that cap currently is at $197,300. That's where that number comes from. PRF cannot fund, PRF funds cannot be used to fund compensation above this amount. Audits of PRF funds will undoubtedly include a focus on highly compensated individuals, and any compensation above this level will be tracked. So on the next slide, as you can see, the definition was a little bit unclear. Oh, I think we can go back. I'm sorry, we skipped one. Yeah, it's the same one. So the purpose of the PRF program, there's two main parts here. So to prevent, prepare for, and respond to coronavirus domestically or internationally for necessary expenses is the first one. And then the second one, only for healthcare related expenses or lost revenues that are attributable to coronavirus. So this implies a broader category of acceptable uses, arguably including costs unrelated to coronavirus, but the recipient would normally have funded with revenues that they would have had but for the coronavirus. However, best practice is to use the funds for the specific categories that HHS has established, which are in front of you on the slide. I will now turn it over to Colin, who will address the specifics of the Provider Relief Fund reporting portal.
Thanks, Neshka. So HHS, as you've probably heard by now, has opened its PRF reporting portal as of July 1st, 2021. HRSA, which is the agency that's been sort of spearheading the Provider Relief Fund distributions and reporting, developed this portal to enable recipients to comply with the mandatory reporting requirements. I remember getting a lot of calls last April and last May from providers who had received this money. HHS had put out terms and conditions that talked about reporting, but there was no detail about, how these reports were going to be made, what was going to be in the reports. And so this has been a constantly evolving process over, the past year and a half almost, to the point where we now have a reporting portal that's been created. And this is how recipients of PRF funds will make the reports that are required by the terms and conditions. There's a two-step process to submit your report to HRSA through the reporting portal, and the link is available here on this slide. First, you have to register as a user, and then the second step is completing the reporting, going through the different questions and filling out the report using the portal. Recipients have to report on a long list of required data elements in each payment received period, which we'll go over in a minute here. In each period in which they received one or more payments exceeding $10,000 in the aggregate. The reporting deadlines that have been set are end at 11:59 on the last date of the reporting time period. And if a recipient does not report within the respective reporting time period, they'd be considered out of compliance with the terms and conditions, and their PRF funds for that period could be subject to recoupment. This slide has the various periods, applicable periods when payments were received, the deadline to use the funds, and the reporting time period. You'll see right now we are in period 1, as payments received from PRF fund between April 10th, 2020 and June 30th, 2020. The deadline to use those funds was June 30th of this year, and we're now in the reporting time period that ends on September 30th, 2021. So that's the first deadline that I would say most nephrology practices who likely receive payments during that first period of distributions are likely in this reporting period now and are working on reports that are due at the end of September. If your practice received payments in different periods, including later in 2020 through different levels of distributions, there will be additional reports required based on the payment received periods listed in this slide. If recipients can't support a PRF payment as either an eligible expense or lost revenue, they must return the balance through the PRF portal by October 30th, 2021. HHS has put together a very thorough reporting user guide to guide reporting entities through the entire reporting process. The portal will allow recipients to save information as they're submitting, so it's not a portal where you have to complete the entire report in one fell swoop and submit it. You can save your information and go back and find additional information, do more digging to make sure that you're answering all the questions accurately and completely, and then submit it when you've gone through that process and are confident in the report. But it is helpful that you don't have to have everything prepared and sit down and do it all at one time. You'll be able to save and then come back to it and finalize and submit it. When a provider logs into the reporting system, you'll need to confirm the record's accuracy with respect to your organization. And HHS has instructed that if something looks wrong, maybe the legal name or tax ID number or other demographic information about your organization, that you call the provider support line rather than annotating notations or corrections in the actual report or the corrections box listed in their portal, because this box would not be reviewed by HHS. So if you get into the reporting system and see something that looks wrong, suggest calling the provider support line and seeing how they can fix it on their end. The reporting user guide is available at the link in this slide, and as Kim said, the slides will be available, so you have links to these resources. I'll go through a few of the required data elements here. Recipients, including nephrology practices, are going to need to report their use of the PRF payments using their normal method of accounting, so either the cash or accrual basis. A practice or other recipient that's received $500,000 or more in PRF funds must report expenses in greater detail by reporting the level of expenses in each of the subcategories that Neshka mentioned earlier. Nephrology practices that expend a total of $750,000 or more in federal funds, including PRF payments and other federal financial assistance during their fiscal year, are subject to single audit requirements, which have their own set of regulations that are cited here. The basic required data in the reporting system includes essentially three elements: the total payments that were received or rejected, and if they were rejected, an attestation would be required for the payment received period that corresponds to the reporting period. So remember, you're doing one report for each of those payment received periods, and there are 4 of them. We are in the first period right now. The amount of interest earned on PRF payments from the payment date until the expense date has to be reported if the funds were held in an interest-bearing account, and the federal tax classification for the reporting entity. As Nesco mentioned, the PRF funds are seen as federal assistance to providers, but they should not be used before other sources of revenue or other assistance were used. So nephrology practices and other recipients of these funds must report any assistance received from other sources during the period of availability. This would include things like PPP loans or other small business loans that may have been available and provided during that time. Any funding from FEMA programs under the CARES Act or other public assistance programs, funding received through CARES Act testing reimbursement, local, state, tribal government assistance, business insurance like business interruption insurance, or other assistance. These other sources of revenue and assistance will need to be reported in the PRF funds report. And again, it will need to be reported based on each period of availability. So you're looking at the funds that were received during the same time period, April 10th, 2020 to, I think it was June 30th, 2020, that first time period. You're looking at just that time period for purposes of reporting other assistance received. And again, if the practice only applied for assistance, so say you applied for a PPP loan but did not get it, there's no reporting of that required. I'm going to turn it back over to Neshka now to talk about getting more into the details of the 2 main categories of how providers can use these funds. First of which is unreimbursed expenses attributable to coronavirus.
So for unreimbursed expenses attributable to coronavirus, recipients are required to report on the net unreimbursed expenses attributable to coronavirus that have not been reimbursed by other sources. And also that those sources are not obligated to reimburse. So recipients must carefully consider other financial assistance that they received, including other PRF payments, when determining net unreimbursed expenses attributable to coronavirus. As I stated earlier, and Colin reiterated, the PRF fund should be used as the last resort and not until all the other monies that could be applied to these expenses have been expended. So reported entities are required to report healthcare-related expenses net of other reimbursed sources, such as payments received from insurance or self-pay patients, amounts received from federal, state, or local governments. And these reports are to be done in two categories: general and administrative expenses, or G&A expenses, and other healthcare related expenses. Now, it's important to note that in its FAQs, HHS clarified that for purchases of tangible items made using the PRF payments, the purchase does not need to be in the provider's possession, such as backordered personal protective equipment or capital equipment, so long as you make the payment for such tangible items. If you made the payment within the period for reporting, then the practice must report that. So some examples of these on the next slides are monthly payments related to mortgage or renting a facility. So if a practice needed additional space or space to isolate COVID-19 patients, this would be covered. Premiums paid for property malpractice business insurance to the extent it was relevant to operations. And then workforce-related actual expenses paid to either prevent, prepare for, or respond to COVID-19, including all of training, staffing, temporary employee, or contractor payroll. Also, extra benefits supplementing an employee's salary, including hazard pay, travel reimbursement, employee health insurance, with that caveat that executive compensation must be under $197,300. Also, lease payments for any new equipment or software, for example, needed to establish a new telehealth program, would be covered under general and administrative expenses. Of course, all of the utilities, such as increased lighting, cooling, ventilation, increased cost of cleaning, disinfection, or additional third-party vendors for any services related to coronavirus. And finally, any cost not captured in these specific categories that are generally a part of an overhead structure, if it's related to coronavirus, would be absolutely covered. So the healthcare-related expenses attributable to COVID-19, again, they have to be attributable to COVID-19. So the supplies, including PPE or hand sanitizer, would absolutely be covered, and any type of supply that is used to prevent, prepare for, or respond to. Same thing with equipment, any ventilators, updates to HVAC systems, additional dialysis machines would be definitely covered. So information technology, this would cover again a lot of the practices that switched over to telehealth to see the patients. So this would be covered under the IT healthcare related expenses, because they are directly attributed to establishing a new telehealth program due to COVID-19. Expenses paid for facility related costs, including the lease or purchase of permanent or temporary structures, as well as accommodating both patients with COVID and isolating patients that do not have COVID would be covered. And of course, this category has a catch-all category of other related, other. So as long as these expenses can communicate, the nexus can be established between success and COVID-19. HHS has also provided us some additional instruction related to reporting of expenses. According to HHS, providers should first apply reasonable assumptions when estimating the portion of expenses that are reimbursed from other sources, and then they should use the marginal increased expenses related to coronavirus. Now, HHS has provided some examples, and I think it's beneficial to everybody to go through a couple of these examples. So if we assume that a practice had a $5 increase, and this is the example that HHS uses, a $5 increase in expense of cost to provide an office visit due to coronavirus, such that pre-pandemic average cost of providing an office visit was $80, and that post-pandemic average expense was $85. So, for example, if Medicaid reimbursed under that level at $70, recipients should then report the full difference or the $5 as a marginal increased expense because they were not reimbursed at the level of $85. So second example, if you have a Medicare reimbursement at $80, so once again, under that $85 level, recipients should again report $5 as marginal increased expense attributable to coronavirus. And then finally, if you have a commercial insurance reimbursement at $85, which is the level of actual cost already, the provider should once again report $5 as increased cost of post-pandemic visit, and which would be the marginal increased expense. Now, the reason why is because the level of reimbursement by commercial insurance is already at $85, but they did not provide additional $5 to account for the increase. So only the HHS explains that only if the commercial provider provided $85 of its reimbursements, which is the actual cost of the care, and provided an additional $5 for the increased marginal expense, then the recipients would not be able to report that $5 extra.
Neshko, this is Kim. You're cutting in and out a little bit, so I think you need to lean a little closer to your microphone. And I know some people missed that example. In the interest of time, we're happy to review it again separately. We're not going to review it again now, or we won't get through everything, but we will definitely be available to go over that example again if people still have questions about it. Thank you. Okay. Neshko.
Absolutely. And I would be more than happy to either provide in an email or speak to anybody that would like to discuss this, because this, I think, is one of the most important parts. And then on the next, if we go to, and then once that calculation has been done, then the practices are required to apply reasonable assumptions to reduce this amount based on any other assistance received, because once again, it is the last resort payment. So practices that fully expended the applicable PRF payments on the healthcare related expenses must report their 2019 and 2020 aggregate actual patient care revenue. HHS announced its changes to its FAQs in October of 2020, that providers can use PRF funds in 2020 to cover the difference between their 2019 and 2020 actual patient care revenue, with some adjustments for COVID-19 related expenses. Now, HHS has historically maintained a broad definition of COVID-related expenses to include all amounts incurred for both direct patient care and overhead activities, which are related to treatment of confirmed or suspected cases of coronavirus, preparing for possible or actual coronavirus cases, or maintaining healthcare delivery capacity, which includes operating and maintaining of all facilities. Finally, HHS has also advised that PRF payments may be used to support COVID-19 vaccine distribution, not for the payment for actual vaccines, because there's a different allocation of funds for that, but for the distribution costs themselves. Now, once a recipient has totaled its COVID-related expenses, which are not otherwise reimbursable, then they're required to calculate the difference between its 2019 and 2020 actual patient care revenue, which are gross charges for patient services delivered, minus contractual adjustments from all third-party payments, charity care adjustments, bad debt, and any other discounts or adjustments. So HHS has also clarified that patient care is healthcare services or supports as provided in a medical setting, at home, via telehealth, or in the community. So the only items that are not included in patient care are insurance, retail, or real estate values. Now, except for skilled nursing facilities where this is a patient care cost item, or grants or tuition. So as far as lost revenues attributable to coronavirus, now practices that did not fully expend the applicable PRF payments on healthcare related expenses must use the lost revenues to report, and these lost revenues must be attributable to coronavirus. So lost revenue reporting uses the same definition of patient care revenue, which is net patient care service revenue for the delivery of healthcare services directly to patient in an applicable setting. Recipients that did not fully expend the applicable PRF payments must report lost revenues in accordance with one of three methods. And these methods are actual patient care revenue method, budgeted and actual patient care revenues method, and any alternate method. So I will once again turn to Colin, who will provide more detail regarding the three methods, as well as dive into issues surrounding potential audits and investigations.
Thanks, Neshka. So going into a discussion of the lost revenues, as Neshka said, there are three potential methods to report lost revenues. The first required data element is the requirement to report the calendar year actual revenues by quarter and payer mix. And so this will be include actual revenues and net charges received from Medicare Part A and B, from Medicare Part C, from Medicaid and the Children's Health Insurance Program, from commercial insurance, and from self-pay. The practice will also need to report any other gross revenue or net charges from other sources received for patient care services, not included above, for the calendar year. Recipients will have to report quarterly revenue information for calendar year 2019 through the end of the period of availability. Recipients will report revenues net of charges from patient care segregated by both payer mix and by calendar year quarter for each quarter during the period of availability. This method of reporting will calculate lost revenues for each quarter during the period of availability as a standalone calculation, with the 2019 quarters serving as a baseline. Each quarter in which the recipient suffered lost revenues will be totaled to determine an annual aggregate lost revenue amount. And the sum of all those annual lost revenues will represent the total amount that can be applied towards PRF payments. So this is the method, comparing actual revenue between 2019 and 2020 that HHS will use to calculate lost revenue. The second option, as Neshka noted, is using 2020 budgeted revenue to calculate lost revenues. If a practice takes this option, it must report quarterly revenue information for calendar year 2020 through the end of the period of availability, and the recipient must report both budgeted and actual revenues, net of charges from patient care segregated by payer mix and calendar year quarter during that same period. If a practice wants to use the budgeted revenue option for determining lost revenues, the recipient must also submit a copy of their 2020 budget, which must have been approved on or before March 26, 2020. Along with the copy of your budget, there must be an attestation from the CEO, CFO, or other responsible individual, likely executive or owner of the practice, attesting that under federal law, the exact budget being submitted was established and approved on or before March 26, 2020. So it's very clear that a practice that did not have a budget approved for 2020 prior to March 26, 2020 cannot go back and create one. This is something that will be likely scrutinized carefully by the government when they do come in and audit. And so it practices taking this approach using budgeted revenue, which may be helpful in showing lost revenues versus what was expected in 2020 based on expansion of service lines or opening of new offices and things like that. We'll just need to be careful and have good documentation showing what those projections were for 2020 and that those projections had been made prior to March 26, 2020. The third option for calculating lost revenues is an alternate method, which is sort of a catch-all that may afford providers some flexibility, but will likely face even further scrutiny than the budgeted method. In the alternate method, recipients will report quarterly calculated lost revenues for calendar year 2020 through the end of period of availability. And recipients would submit a narrative document essentially describing the methodology used, an explanation of why the methodology is reasonable, and a description of how the lost revenues were attributable to coronavirus, as opposed to a loss from any other source. A calculation of lost revenues attributable to coronavirus using the methodology described in the narrative document. HRSA will notify the recipient if this alternative method where the provider comes up with its own methodology to calculate lost revenues and has to explain it and document the calculations used. HRSA will review those and determine whether HRSA thinks that the alternate method used was reasonable or not. If the method, after review by HRSA, fails to demonstrate a nexus between the claim lost revenues and coronavirus, the recipient will have 30 days from the notification by HRSA to either resubmit the lost revenue calculation using one of the two other methods. And so it's yet to be known, what other methods people will use, what will be approved by HRSA, what will, result in HRSA telling you to go back to the drawing board and use one of the other two methods to calculate lost revenues. But I think fair to say that using any method other than the actual revenue or budgeted revenue methods will require further interaction with HRSA, likely more questions, and the potential that you have to go back and use one of those other two methods. According to HHS, recipients that are using this method of reporting are going to have an increased likelihood of audits by HRSA. So after going through the reporting process and claiming lost revenues, if a provider cannot substantiate their PRF payment through a combination of lost revenues and eligible expenses, providers would have to return any unused funds from the period of availability within 30 days after the end of the reporting period. So the PRF payments from period 1, which is the reporting period we're in right now, that period ended on June 30th, 2021. If they're not used for qualifying purposes, they would need to be reported and returned by October 30th, 2021, which is 30 days after this reporting time period ends at the end of September. We've got a table here showing the other reporting time periods and deadlines for returning unused funds. Recipients who have to return funds to HHS would also need to remit any interest on those funds if those funds were held in an interest-bearing account. There was no requirement to hold funds in the PRF funds in interest-bearing accounts. So interest is not required on return funds, but if they were held in an interest-bearing account, any interest would have to be returned as well. HHS has said that all return funds will be subject to an automatic audit for accrued interest. As we mentioned earlier, recipients that received high dollar amount of PRF funding that would be $750,000 or more, or which expended $750,000 or more in certain federal grant payments. So this could be payments from other sources than the PRF funding program. They're subject to single audit requirements, which are an organization-wide financial statement and federal award audit of any non-federal entity that expends $750,000 or more in federal awards in one fiscal year. The reports for single audits are generally due 9 months following the conclusion of a provider's fiscal year. And HHS provided an automatic 3-month extension to recipients that would otherwise have reports due between October 1st, 2020 and June 30th, 2021. And we have a slide here on the next slide showing the various deadlines for the single audit deadlines if your organization received that level of funding. This is something that your accountants likely have the best knowledge of and have been through before with other federal contractors. Generally, go through these type of single audit processes. The grant of the PRF money has expanded these single audit requirements to healthcare providers who generally do not have to go through this process. So there's specific guidance that applies to the single audit and specific regulations in the Code of Federal Regulations. But here are the deadlines, and the first deadline will be February 1st, 2020, or was February 1st, 2021. And they will continue throughout this year based on the provider's fiscal year end date. So in terms of audits, on the next few slides, I just wanted to go through some thoughts and best practices for preparing for the audits that we will likely see from the government. Obviously, we don't know yet what audits from HHS or other agencies are going to look like, or how extensive they'll be. Because of so much of the information needed for the Provider Relief Fund reporting and backing up the amount of funds you received is going to come from an organization's finance office, from their accountant. There needs to be a close working relationship between the compliance office, the compliance officer, and finance to track the PRF requirements and ensure that the organization has documented its compliance with the terms and conditions. Recipients should have a documented record keeping and record retention policy that's applicable to PRF payments that are received and obligated and expended. For record keeping, I would say at least probably 6 years, because that is the False Claims Act statute of limitations. So if there are allegations of not returning PRF funds or inappropriately expending PRF funding, the government has indicated that could be a potential false claim against the government, or at least a reverse false claim. And so keeping all documentation related to the PRF funds received and the reporting that was done, and documentation related to the lost revenues or increased expenses to support maintain, keeping the PRF payment or returning part of it, I think for at least 6 years would be advisable. All staff who are responsible for the receipt, obligation, and spending of PRF funds should be trained on the basic compliance obligations under the terms and conditions, and the record keeping and record retention requirements applicable to this financial information and other documentation needed to substantiate the PRF funds. On the finance side, recipients should, if possible, segregate PRF funds on accounting ledgers to track the direct and indirect spending and application of the PRF funds. Potentially separate the PRF payments from other sources of payments or other funds or similar services that so you can ensure that they're segregated and avoid potential overlap. As we've gone through, these funds are for lost revenues or expenses that were not reimbursed from other sources. So to be able to show where those other sources are and what those other sources are and how they're separate from the PRF funds that you received can be helpful to demonstrate that, the PPP loan was already applied against these expenses, but there was, additional expenses on top of that amount. And so we've claimed, X amount of dollars of PRF funding to cover those expenses that we'd already applied our PPP funds towards. Setting up general ledger codes for each funding program or each grant for each entity in your organization, maybe by tax ID number, just ways to be able to document where these funds went and track how they're being spent so that you can, one, go through the reporting process, but two, have good documentation in case that report is audited and you have, HHS or the OIG asking questions and asking for documentation to support the report that was made. Additionally, for direct expenses, so say you had to, buy additional PPE, lease additional space that was related to isolating COVID patients, or purchasing equipment for telemedicine that you would not have invested in but for coronavirus. If you have a separate cost center for those expenses, it can help to simplify the reporting and prepare for potential audits coming down the pike. Additionally, for losses, if you can separately identify those losses on a monthly or quarterly basis based on one of the lost revenue calculation methods, being either the actual revenue calculation or the budgeted revenue calculation, demonstrating the canceled procedures, if your facility was closed for some period of time, different levels of reimbursement that you received for if telehealth reimbursement was not as robust as in-person reimbursement would have been. Any kind of losses that can be directly attributable to COVID-19 should be tracked as well. So just some thoughts on likely targets for audits. The HHS or the OIG may audit recipients based on the information that is reported in these quarterly reports that we're going through right now. So, this is going to give the government lots of information about how much PRF funding organizations received, which they should already know, and they do know, but how they spent it and whether an organization ends up returning funds, and the different categories of expenses and lost revenues that organizations are claiming against the PRF funds. It'll take the government probably some time to dig through these reports, but they might identify some trends. They might focus on the largest recipients or recipients who, in looking at the overall trends of the data collected in the reporting process, who stick out as anomalies. So if every a practice in one geographic area sticks out as buying so much PPE, so much more than every other practice, but in the same specialty, they might be looking for things like that where what's going on there. They might have more questions about the reasonableness of of the expense, even though it was likely to prepare for or respond to coronavirus. Why did the PPE cost, say, 10 times more than every other practice claimed their PPE costs? So that will be likely targets, based on the data that's gathered and the analysis that's done of that data. recipients using the alternate method of reporting lost revenues, where the provider would come up with their own method and try to explain their methodology. HHS has already said that they are going to be targets of audits or potential investigations. So that's a clear one. Recipients who return PRF funds will be subject to automatic audits for accrued interest. And HHS could also enact some kind of random auditing that would reach a wider range of recipients. So the OIG, it obviously has COVID fraud and abuse issues on its work plan. And it wouldn't surprise me to think that it, in several years, it doing a larger study of the various COVID, relief packages, including the PRF funds, and if there were proper controls in place to identify fraud and abuse in those programs, it could be a wide-ranging OIG audit that hits, say, hundreds of providers throughout the country, and they do a larger study of it in the Office of Investigations or the Office of Audit Services. HHS could also direct MACs, the Medicare Administrative Contractor, to spot check audits, or the Uniform Program Integrity Contractor to do audits of PRF funding. So there's more to be seen on who will be doing the auditing, but clearly DOJ, HHS, and OIG will have authority to and will be coordinating auditing to ensure that these funds were received properly, received by the proper entities, and any entity that received them comply with the terms and conditions. And last couple of thoughts on preparing for audits. For indirect expenses, it'd be great to identify and document an appropriate method allocation methodology to distribute those indirect departmental expenses to COVID-19 accounts, and developing and documenting a methodology to identify lost revenue as a result of COVID-19. So this could be accounting for known cancellations of elective procedures and visits, determining revenue based on decreased admissions or new patients admitted to the practice, reviewing year-over-year revenue decreases, and understanding any trends in the recent revenue to determine if there was an increase or decrease that was occurring before COVID-19. So this may come into play if we're using the budgeted amount to determine lost revenues. If there was, a trend of increasing services at a certain office or a certain service line that all of a sudden dropped off a cliff in 2020 when COVID hit, but the expectation was, and the budget expected, that was the budget that was approved before March of 2020, expected that trend to keep increasing. That can be a way to sort of bolster the lost revenue that the practice can claim if the budget was approved prior to March 26, 2020. So, looking at the data, looking at the trends, looking at what's available in terms of using that budgeted method of calculating lost revenue can help the practice prepare for audits and have documents that will substantiate the reporting process and be available in the case of an audit. On the last slide here, we just have some links to some of the guidance that's out there. This program, the PRF program, came with, it was thrown together very quickly. As you all know, providers just received money in their bank account one day, and then, it seemed like no strings attached at the time. Obviously, that was not true, and we didn't expect that to be true because the government quickly put out a long set of terms and conditions that applied to receipt and retention of those payments. So the guidance has evolved significantly over time. These links that go to HHS's website and guidance on the FAQs, the reporting portal, the reporting user guide are all current as of today. That does not mean they won't change in the future. So as we've seen with this program, it is a constantly changing and evolving program. The guidance has changed. The HHS's interpretations of its guidance have gone back and forth several times. So, understand lots of people have questions, about very specific issues. Not sure we'll have much time to get into all of those questions today, but as Kim said, reach out to any of us. We'll make these slides available. They'll have links to this guidance and our contact information, and we'll be happy to talk about more specific questions that aren't answered by the guidance that's available. Again, here's our contact information. Thank you so much for joining us today. We appreciate all the interest and are here to answer any questions. Thanks.